All right, let's dive into one of the biggest questions every new investor has to ask. Should I put my money into individual stocks or this thing called an ETF?
Yeah, seriously, it feels like this huge, overwhelming choice right at the start. Where do you even begin?
This really gets to the heart of it, doesn't it? Do I try to be a genius and find the next big thing? Or, is there a safer way to play? It feels like betting on one horse to win the race versus just owning a piece of every horse that's running.
That's the perfect way to look at it. So let's break down those two main paths you can take.
So, path number one, the individual stock. When you buy a stock, you are literally buying a tiny piece of one single company. Let's say there's a cool new company that makes delivery drones. You buy their stock, and boom, you're a part owner of that drone business. Whoa, okay, so if that drone company becomes a massive success, I'm celebrating. But what if their big new drone has a major glitch on its first flight? My entire investment could just nosedive right along with it. That really feels like putting all my eggs in one basket. Exactly. And that whole all eggs in one basket problem, well, that's what the second path, the ETF, was designed to solve. An ETF, that stands for Exchange Traded Fund, is basically a big shopping basket that's pre-filled with stocks from tons of different companies.
So when you buy just one share of an ETF, you're not just betting on that one drone company anymore. You're actually buying a tiny, tiny fraction of every single company that's inside that basket. Like an S&P 500 ETF. That means you own a little slice of the 500 biggest companies in the US all at once.
To make this super clear, let's use an analogy. Just imagine for a second that the entire stock market is one giant apple orchard. Okay, this really lays it out. Buying an individual stock is like walking into that huge orchard and trying to guess which single tree is going to grow the most best-tasting apples this year.
And buying an ETF is like saying, you know what, I'm not going to guess. I'm just going to take one apple from every single tree.
You got it. And this is where the risk becomes so obvious. If you bet everything on that one tree and it gets struck by lightning or some disease wipes it out, well, your entire harvest for the year is gone. Poof! You walk away with nothing.
But if you took one apple from every tree, sure, a few of those trees are going to have a bad year, maybe produce some rotten apples, but other trees are going to have an amazing year. And when you look at your whole basket at the end of the season, you see that the orchard as a whole is growing, and you've got a really solid, reliable harvest.
Okay, so the analogy makes sense. Now let's put that aside and look at the cold, hard facts in a direct head-to-head comparison. Let's run through this. First up, risk. An individual stock is high risk. I mean, it can jump up or down 10%, even more in a single day. An ETF is way lower on the risk scale because it's so spread out and stable.
Right, so one company's bad earnings report doesn't totally wreck my portfolio? Okay, I like the sound of that.
Exactly. Next, time commitment. Picking individual stocks means you have to be doing research pretty much constantly. ETFs, on the other hand, are famous for being set it and forget it.
And I guess the trade-off for all that safety and ease is the potential return?
That's the one. A single stock has a higher potential to beat the market. It's a long shot, but possible. An ETF isn't trying to beat the market. It's just trying to match the market, which over the long haul gives you a solid, moderate return. So after looking at all that, what's the actual game plan for a beginner? Well, it turns out there's a pretty well-known golden rule.
And here it is. Build the core foundation of your portfolio with broad ETFs for safety, and then only use a small percentage of your money to take calculated risks on individual stocks.
So it's not really an either-or choice. It's more about building that safe base first, and then maybe taking a few swings on those individual apple trees. When they say a small percentage, what are we talking about?
Well, a common rule of thumb for beginners is to keep those individual stocks to about 5, maybe 10% of your total portfolio.
Precisely. So step one is your foundation. You use ETFs for that safe, consistent, whole orchard kind of growth. That's the biggest part of your investment.
And then step 2 is the fun part, the calculated risks. Using that small slice, that 5 or 10%, for those individual stocks you've really done your homework on.
And that's really the key takeaway here. It's not about choosing stocks or ETFs. It's about building a smart strategy that fits your own goals and how much risk you're comfortable with. So the real question isn't which one is better. It's what's the right balance for you?